I'm Vincent Au. My company is actually ALPS Advisory. So it's a multi-family office based in Hong Kong. The company itself has a long history, so it goes back, to the 90s. But I'm a founder actually did management buyout back in 2003. So at a high level, we manage about 14 family relationships, multi-asset, multi-manager. So that's our main mandate and main approach. So I've been joining the company for almost 6 years now. So I'm a chief investment officer. So I'm responsible for anything investment related. And prior to that, I was working for Asia Capital Reinsurance Company. So that's based in Singapore. And that company is actually backed by Thomas II Kasama. So Singapore government and the Central Bank of Malaysia. And then prior to that, I was based in the UK, working for pension funds and investment group pension fund. And I also worked for Mercer. I was a global pension investment manager at the time. And then before that, I was a G7 global bond fund manager for British Airways Pension. And I started my career as a credit analyst with Lloyds TSB Bank, or Lloyds Banking Group these days. I have a very diverse career background, in terms of geography and in terms of industry. So as I mentioned, I started as a bank and then worked for insurance company, pension funds, consultants, and now family office. So going back to your original question, Asia Capital really definitely taught me something. But more specifically, I would say my multi-asset skills had to develop over time. Not only from the last role. The last role, what taught me was that was my first stint in Asia. Learn more about what Asia people do. I mean, so I guess the key takeaway from my last role was before I came to Asia, I always under the impression that Asia is something different. They might do things differently, because of different culture and different needs and requirements. And then of course, once you're here, you do see a different investment community and you have a different network. So and absolutely, you get to understand better about different needs of the local people. So not only looking at the world through my usual Western lens as a UK based investor, but now more bespoke from Asia angle. So I think that is a key thing that I learned and took away from my current role, and which is very helpful. In fact, that is exactly what I mean by, I learn through my work experience over my career, and then come to, where I am. And at this juncture, I do feel, I have everything I need, to apply for different clients and requirements and needs. So going back to your question, is the essence about, managing, multiple mandates at the same time is about efficiency and effectiveness. So think about it, a lot of people have a question about, okay, Vincent, you're working for a multi-family office, you have multiple mandates that you're managing. So how can you keep up with it? So there's so many different portfolios. And then I said, look, but if you break it down into the functions, then it's actually not so bad in the sense that, so yes, I have 50 different mandates. But if you think about it in terms of function, there are three main functions. One is the income function, one is the return-seeking function, one is the diversification function. So I have what I call the master fund. So it's just more like a model portfolio of a private bank. But within the master fund, it's a simple multi-asset approach, but I purposely divided the fund into three functions. So your traditional fixed income is what I call the income function, because as time goes by, I don't think the fixed income as a description is fit anymore. Secondly is the return function, and then as I mentioned, the diversifier. So what each function does. So income function means it should generate steady income return, and plus it should have a capital preservation at the same time. So that's what it does. And then secondly, for the return seeking, so laterally, what the client wants, so the client will have their own, typically will have a benchmark of an equity, So you want to be able to produce an equity-like return, or probably less risk. So it's what I call the enhanced return function. And finally, yes, some clients, they will also like to have something different. So what it means by different, it means low correlation against the equity and low correlation against the credit. So once you understand the three functions, by managing and trying to achieve the bespoke objectives of each functions, then you very much know the playbook quite well. So then all you need to do then is go to the individual clients and understand what the needs and requirements and risk parameters. Then you can choose and pick from each function and mix and match to achieve what they got. So it's quite systematic in a way, but also very efficient. From our investment strategies, again, there's no secret sauce. If you talk to most of the asset allocators, the for multi-asset portfolio, typically, means there are two things to it. One is the top-down approach. The top-down obviously is to understand the macro landscape, and what's the implications on different asset classes, and then you can home in, through that kind of analysis to find your opportunity set. So that's one way of dealing with it. And then the second part is obviously the bottom up. Going back to the top part, the first function. So yeah, so if you look at the macro landscape, so obviously, you need to understand, how the macro development will mean, to your portfolio. So like, the very recent times, the narrative is, interest rate or inflation will quite likely to stay higher for longer. So then you need to think, along that narrative. So what would that mean, to any of every other asset classes? So if you do care about the inflation, do you find anything, that can give you that kind of inflation protection? Or at the same time, would that mean, that there may be potential risk against your portfolio capital as well? So then then through that mindset, then you think about, okay, what kind of asset classes could do better? So in terms of private equity, as I mentioned, or private market, okay, I think the other element that people should really think about is not just the inflation but also growth together. So 2023 taught us a lesson that high inflation actually may not necessarily be a bad thing. Why? Because when during a high inflation environment, companies that can actually pass through the cost much easier. They have the skills. Yep, inflation is high, so that's why I hike my price. And in return, the margin is maintained, and seemingly, the economy is doing fine, so everything's okay. So that's what we're seeing. But of course, the essence of that is, the better company, the better quality company will do better, and that's also reflected, from the public indexes. I.e., if you look at the Magnificent Seven, obviously, they call Magnificent Seven for a reason. Not they are massive company. They're in the correct things, like the AI and what have you. And they have the pricing power, so they can pass through the cost. But then once you go down to the capital structure, and you will find companies with less pricing power will have more trouble. So then all of a sudden, the Russell 2000 are not performing as well as the Magnificent Seven for good reason. Equal weighted index of S&P 500 is not performing as good as a Magnificent Seven for good reason. So the essence of that is, if we believe that going forward growth is going to be fine, then in fact, I will argue inflation is fine. But what could be more problematic is, either you think growth is going to come down. So that means, even when the company have the pricing power, that it might ultimately have an impact on the demand. So then the margin or the top line revenue growth may not be maintained. So that's one concern. And what could be even more damaging is when both inflation and growth are going down at the same time. So that means not only you can't maintain your margin anymore, but you also may suffer from sales anyway. So and then through that thinking mindset, then you have to think about your playbook. So equity obviously in the growth environment can normally do better than the private credit, because they rely on the economic growth and what have you. But if you believe growth is going to be slow or even go into recession, but not to the tune that to what people describe as a hard landing, And private credit, technically speaking, may do fine as well. Yeah. And relatively speaking, it will do better than the private equity. Why? Because, it's a high up on the capital structure, so you got better protection. And also, it promises steady income, and it's an inflation link, so you can earn a high coupon at the same time. And as long as the default rate is being controlled, then technically you're fine. So I use that as an example, and you can understand, why mad, about pocket when I think through about the macroeconomics and how does it, impact my selection of different asset classes. I think the good thing about the multi-asset manager is, the whole world is my playground. So if something do bad, like most people talk about, China is a risk. Okay, fine. I mean, like, I've been talking to people. People talk about potential regulation hike, and then the conflict between the West and the East. To me, yeah, everything makes sense. And at the same time, when there's a risk, there's also opportunities. So having a multi-asset background, it helps me to navigate, in every different situation. So when something is quite difficult, I can always, find a different way, to play and get better results. So say, for example, we talk about China. So if China is difficult, well, then just stay on the sideline and then look elsewhere, So that's not a major issue for us. At the same time, if you're thinking that credit could be more troubles to come, so we talk about the maturity wall, default rate may go up. Then you stay away from credit, and then you can always look for other strategies like hedge funds. So in that case, hedge funds with a distressed mindset or more like an activist mindset, can actually serve better for clients in those occasions. So in summary, I think having that background to understand the different asset classes obviously help, and plus having a wider mandate that enable me to not only look at different asset classes but different regions obviously helps. So information ratio is a classic explanation for that. So when you have a greater universe, plus assuming that the manager scale is okay, just simply having a greater universe will enhance your information ratio. So yeah, I think having a multi-asset background and a diverse understanding of different asset classes clearly is an advantage. So yeah, I mean, we can go through each aspect from top down to bottom up individually. So from top down, so we know inflation is still high, and the current narrative in the market isn't high for longer. But then at the same time, the whole market has already priced in a very aggressive rate cut. For me, that uncertainty is not helpful, and I'm not going to take too much bet against the market or the fundamental, because I think both can equally play out. Yeah. So I think most people pay a lot of attention on what should they be positioning for one way or another, i.e. should they be positioning for more rate cuts, just like where the market are predicting right now, or they should be otherwise. So simply put, if you believe how the market is pricing for, then obviously it's a risk on, because there'll be a lot of rate cuts, then the Federal Reserve will become very dovish. So generally, you don't want to go against the Fed. So that's a risk on environment. On the other hand, if you don't believe that's the case, then clearly it's a risk off environment. So a lot of people pay a lot of emphasis on that, then trying to play against it. For me, I think it's actually very dangerous at this juncture. The simple answer is, I watch the economics every day and I've done well. The simple thing is, I recognize that the economy is still very strong. I can't argue with the real data. At the same time, I also acknowledge that the tighter monetary policy will have a time lag, and with such a policy, ultimately it serves a function to make some damage to the economy. So that's the whole purpose of it. So to believe the tighter monetary policy have no damage to the economy is also hard for me to understand. So that's why to me, instead of, predicting yes, there'll be more rate cut or no, that wouldn't. I think that's a very dangerous game at this juncture, because you very much either risk on or risk off. Either way, you can be very, very, very damaging to your portfolio. Instead, I would try to think about, where are the opportunities I have higher certainty about. One thing I know for sure is, the maturity wars is there. So second half of 2024, there'll be a bunch of companies will require the refinancing. Yeah, and 2025 will get more, and then eventually it will peak. So that is a game to play. Yeah, so that's why so when in terms of my asset allocations, I'm actually very actively sourcing and looking for credit specialists, especially distressed managers that can capture that kind of opportunities. So what can it do? So banks are not lending. Yeah, so public market is on and off, So we know 2023 was a tough time, for people to raise IPO, whether that be IPO or originally, public debt in terms of investment grade or high bond. So corporate bond has been very difficult. So what left, private credit or credit specialists. So this manager can actually talk to companies and then strike a deal, and companies love it as well. Why? Because they need their financing anyway, so they can't get elsewhere, and the manager providing it. And not only that, they know for certainty, and they can have a more bespoke term structure as well. So it's a win-win situation for both. So the companies get what they want, and the hedge fund managers, for that matter, can also earn the benefit by taking up the opportunities. So to me, I think right now the whole community has been spending way too much time talking about soft or hard landing. To me, I'd much rather not play the game and then find something I know for sure will happen, and then find about the solution that can take up the opportunity with higher certainty and greater probability to win.